Good afternoon and welcome to another Mortgage Minute. My name is Jeff Harrison. I'm the guy behind the scenes, and I see that our host and expert, Art Alvarez, is just finishing up the makeup in the green room. He ought to be ready to come in soon. And today is May the 4th. May the 4th be with you. I've waited all day to say that, and I thought, how am I going to work that in? I just need a little help, so May the 4th be with you. Let's bring Art in on that. Hey, Art, welcome.
Hi, Jeff. How are you?
Good. How are you? Is the 4th with you today?
You know, it's funny. I was, as I always do, I was watching the business news early this morning, and I saw that phrase this morning. So I thought it was kind of clever, and yeah, it was kind of funny to hear you say that. And hopefully, my makeup is okay.
Yeah, it looks really good. There's no shininess on your forehead. Everything looks great.
It's not too much.
You ought to be good to go. Yeah, I know there's a lot going on, and you've got a lot for us. So I'm going to back out. I just want to remind everybody, if you're joining us live, I'll be monitoring a comment section. So if you have questions or comments, please put them in there. That's either on YouTube or Facebook. Mm-hmm. And if you're watching afterwards and you've watched what Art has to say about what's happening in the market and the opportunities you have as far as mortgages are concerned for your home, put them in the questions and Art will get to them afterwards. So Art, let's have a great show.
Thanks, Jeff. Looking forward to it. Well, hello, everyone. Welcome to this week's Mortgage Minute. Got a lot to talk about. It's been an interesting week, particularly since we've had the Fed just conclude their 2 days of meetings. So this week, what we're going to be doing in terms of just our agenda is we'll start, of course, with a mortgage rate update. Then I'm going to kind of do a little bit of follow-up on the trigger leads subject that we talked about last week. Then I want to kind of go into the credit score and LLPA issue, the controversy that still continues to rage on. I've got sort of a new perspective on that. And then also want to talk a little bit about equity lending and how that is affected by what the Fed did this week with the Fed funds rate. And then I'll leave you at the end of the program with a sort of a teaser question that we'll provide you the answer on next week. So with that, let's get right into it. First, I want to start with a mortgage rate update. And of course, the first thing always to look at, as I harp on all the time, is what's been happening with the 10-year Treasury bond yield. Well, you can see on the screen now, this is a 5-day chart of the 10-year Treasury bond yield going to last Friday up until today. And what's interesting about this chart is you can, of course, see the movements throughout that last 5 business days. And actually, at the beginning of this week, Monday the 1st, we actually saw bond yields starting to move up. In fact, they got up as high as about 360. And this is not uncommon. Usually the week of the Fed meetings, we often see bond yields start to run up in advance of the meetings. And then what happens once the meetings are over and the Fed announces their decision on the Fed funds rate, then, where it goes from there can vary. But with this particular chart, what you can see is it was yesterday when the Fed announced at the end of their meetings that they were going to raise the Fed funds rate yet again by another 0.25%. Well, of course, the implication being that that probably means mortgage rates are going up by the same amount, right? Well, not really. If you look at this 5-year T-bond chart, the 10-year T-bond chart over the past 5 days, what you can see is we've come off of a high of 360 at the beginning of the week. We're now currently at about 338. So what does that mean? Mortgage rates are actually better now, today, Thursday, May 4th, than they were on Monday before the Fed meetings, which is sort of counterintuitive. Now, you can see this further if you go into our website. Again, I've mentioned before that we have a rate grid that we post, and I call these rate indications because these rates are only that, indications. Your actual rate's going to vary depending on your specific transaction characteristics and your financial profile, credit scores, and so forth. But what this chart tells you in terms of current rates is contrary to the fact that I see media stories still referring to mortgages in the 6s or even 7s. Well, what this rate grid shows you, at least for conforming loans, Fannie Mae, Freddie Mac, FHA, VA, we're solidly in the 5s. So that's actually pretty good. And historically, these rates are pretty decent. And so from that perspective, again, I want to always harp on the fact that things are a little bit more positive than you might think. And particularly when you look at the buy down options at the beginning of or at the top of the grid, there's a lot of talk about homeowners who have a lot of equity, very low rates on their first mortgage, and they're kind of stuck in terms of wanting to maybe sell because they don't want to face today's higher rates? Well, if you look at those first two line items on a rate grid, those buy down options give that homeowner who might be thinking of selling the opportunity, if they find another house, consider a buy down as a way to maybe pursue purchasing that house, consider making an offer that might be at list price, but then ask for the buy down assistance. So that way you can get that home at rates comparable to what they were a couple of years ago. And then that gives you a couple of years to look for rates to fall back down, maybe close to those levels. So then you can refinance the note rate. So the idea here, of course, is what went on. It was the Fed meeting. They did announce the 0.25% increase. But I think part of the reason mortgage rates didn't jump up was because part of the Fed's commentary at the end of their meeting was that they're going to probably pause for now and maybe not raise the Fed funds rate anymore. And of course, that was good news for the bond market. Now, of course, the other factor is, which is not actually on our outline, is the banking fears have sort of reemerged, and that has caused a little bit of disruption in the stock market. So you do see a little bit of that flow of funds situation where money moves out of stocks into bonds. That also helps to keep bond yields down and therefore mortgage rates a little better. The remaining data that's going to come out this week is tomorrow, and that's going to be the employment report. That's going to include things like the number of jobs, unemployment rate, and wage inflation. So that can be a number that can move the market. We'll see how that goes. If it shows that the economy is sort of weakening, then mortgage rates probably will remain fairly stable and not jump up. If it shows a surprise, strength in the economy, then, we'll see what happens. Bond yields and therefore mortgage rates may, creep up a little bit. So that's your mortgage rate update. Now I want to go into the next slide, which is about more on trigger leads. Now, remember last week we talked about how a trigger lead is a situation. I just had this happen again this week. I had started 2 new purchase loans. And in both instances, I had the borrower, after we started the process and pulled their, 3-bureau hard pulled credit report, both of my borrowers commented that they started getting calls. And so, again, that happens when a hard inquiry, a mortgage inquiry is created. That creates an opportunity for the credit bureaus to sell your contact info to mortgage originators, who then call you and frankly try to pressure you into abandoning who you started your process with and go with them. So given that that's happened a couple of times on new customers of mine this week, I wanted to let you know that legislation was just announced or introduced last week, HR 2656, called the Trigger Leads Abatement Act of 2023. So that's good news, because I think that's well overdue. And I think it's the right step to try to get these trigger leads and the process of trigger leads a little bit under control. Now, given that that's good news, this legislation, it's going to take some tweaking, because it's got some, or lacks some features that I think is going to be necessary and is already being talked about in the financial world. The first item is there is a general belief that there should be a carve out for mortgage servicers. Now, a mortgage servicer is simply the lender that you currently make your payment to on a mortgage. And the argument's being made, and I think it's valid, that a lender with thousands of loans that they're collecting payments on, they do have an interest of trying to maintain that portfolio. And if there is a customer who's looking to get a new loan, particularly if it's a refi, that mortgage servicer wants the opportunity to contact that borrower and see if they can make them an offer to keep them in their portfolio. So I think there's some discussion about that occurring. Then the next thing is the legislation really is lacking what we call guardrails to prevent deceptive practices. And what we mean by that, and many of my customers have reported this, the number of calls you can get, and basically the approach of the calls can be pretty aggressive. And in some cases will throw out verbal offers that appear to be the old, not too good to be true type of situation. So there is a belief that this legislation, while a good start, needs to have some better protections in terms of deceptive practices. And then the last thing is this legislation does not actually offer an opt-in opportunity for a borrower. And again, that's being discussed as something that is probably, or that is lacking in this legislation and should be discussed and maybe added to it. So just be aware that, that process is underway. I'm hopeful that this will cause some improvement in the whole trigger lead process and experience. But in the meantime, as I posted last week, a reminder, you can opt out from credit and insurance, by the way, offers by going to optoutprescreen.com or by calling 1-888-5-OPT-OUT, 1-888-5-OPT-OUT. Or you can go online and you can find out more about trigger leads and in particular pre-screened offers at consumer.ftc.gov. So again, that's what I wanted to just update you on with regard to trigger leads. Hopefully, whenever you get to a point where you're looking to get a mortgage, either you've already opted out or maybe this legislation has finished the process, isn't in place, and you'll be more protected from that kind of aggressive soliciting from mortgage originators. So now moving on to the next subject, again, something we talked about last week, the credit score loan level price adjustment controversy. It continues to rage on. I'm still seeing and hearing lots of news stories about this whole new change, although again, it's been in place actually since March. In fact, I saw one news story that was suggesting that, this change means that lower credit score borrowers are actually going to get better rates than high credit score borrowers. That's not true. The less credit score borrowers are going to get an improvement in rate, but they're still going to get hit pretty hard. So they're just going to get less bad LLPAs than before. And of course, the high credit score borrowers, the threshold for best pricing has been pushed up from 740 to 780. But those kind of news stories, again, is why I say, and what I learned at a recent economic presentation by Beacon Economics, is beware the headlines and focus on reality. And I think the overall issue that's being missed with this whole controversy is, in reality, the government-sponsored enterprise loans. Now, GSE is what that is, government-sponsored enterprises, which is Fannie Mae and Freddie Mac. Those conforming loan programs, particularly for credit scores that are on the lower edge of the end of the spectrum, I would say essentially 680 and below in particular, the GSEs, Fannie and Freddie, despite the fact they offer a lower down payment requirement than FHA, are probably not the best option for a lower credit score borrower. And the reason is that they simply do not offer pricing rates that are as attractive as other alternatives. So in fact, what this whole controversy, in my opinion, basically brings to the forefront is the fact that the alternative that is available is FHA. FHA is a better option for lower credit score borrowers, and there's a variety of reasons for that. In particular, FHA is a program that doesn't have the same types of LLPAs as the conforming, Fannie Mae, Freddie Mac loans have. And that's important. So what that means is, as you get lower into the credit score spectrum, you're going to get a better rate for your particular credit score relative to what you're going to get from the government-sponsored enterprises. The other thing about FHA is, what are the other benefits besides the fact that for a given credit score, you're going to get a better rate? Well, for one thing, the annual mortgage insurance on FHA loans, you may have forgotten, was recently lowered for 0.85 with a minimum 3.5% down payment to 0.55. Well, again, for lower credit scores, for a conforming conventional loan, that means that you could often see that the PMI, the private mortgage insurance, is going to be at a higher cost than the FHA mortgage insurance at 0.55. The other things about FHA loans that I really like is you have, in most cases, the ability to qualify with higher debt ratio limits, and then underwriting guidelines in general tend to be more flexible than the conforming Fannie Mae, Freddie Mac loans. So FHA loans, great product, been around since the 30s. I think, frankly, it's probably the best mortgage product ever developed in the U.S. and continues to be this day. I think it serves a very good portion of the market, particularly that maybe arguably the lower served or less served lower credit score borrower. And so what I want to do just to illustrate this point is show you an FHA versus conventional loan comparison based on a certain set of parameters. Jeff's going to bring that up here in a second so that I can show you in real numbers what the differences are for a borrower who has a 675 credit score, again, below that 680 threshold, and see for a particular purchase transaction, we're talking about a purchase price of, say, $450,000, and compare an FHA loan to a conforming conventional loan with a minimum down payment, so you can see what the difference is in the kind of terms that you can get. So on this chart, if you start at the very top, I've got FHA and conventional. And you can see the loan to value. That's sort of an opposite way of identifying the down payment. FHA is 3.5% or 96.5% loan to value. Conventional actually offers a lower down payment amount of 3% for a first-time home buyer. So that's why it says 97. So as you go down a little bit, look at the interest rate line. It's amazing. For a 675 credit score, a borrower on an FHA loan is going to get 5.625. And this is as of yesterday. For a conventional 97% loan with a 675 score, the borrower's rate that was available was actually higher by 1%, 6.625. So then when you drop down to the lower part of the comparison, where you see the payment breakdown, there you're going to see first mortgage principal and interest. And you can see a pretty big difference there. 2543 for FHA, 2795 we'll call it for conventional. Again, the conventional loan has a higher payment. Why? Because of the higher rate, obviously. Now, of course, taxes and insurance are going to be the same. The assumption here is we've got a single family home, no HOA dues. It's not a condo. But then the other thing that jumps out at you is look at the mortgage insurance cost difference. FHA, $197 a month. That's based on the 0.55. Conventional PMI for a 675 credit score with 3% down, the PMI cost is 1.22% annually, more than double the FHA annual insurance cost. So you see a much higher payment of $443. So overall, when you add all of that together, total housing expense, the FHA loan is actually going to offer a 675 credit score borrower a total housing expense of almost $500 a month lower than a conventional 97% loan. Now, somebody's going to say, well, wait a minute, you're leaving out the 1.75% FHA mortgage insurance. That's the first component. That's an upfront premium that is never paid in cash by the borrower, almost never. And instead, it's financed into the borrower's base loan amount. So what that means actually is the principal and interest payment for the FHA loan at $25.43 already incorporates that mortgage insurance component. So even with that included, the fact that the annual insurance is so much lower on the FHA versus the conventional for, again, the 675 credit score borrower putting minimum down, that borrower is still going to get almost $500 a month less housing expense for the FHA option versus conventional. So my point, any of you who are looking to buy a home, if you're in that 680 or less credit score range, and by the way, with FHA, you can go all the way down to 580 with a 3.5% down payment, down to 500 with a 10% down payment. Boy, I'll tell you, if you're at that 680 or lower, FHA is the way to go. I would definitely look at that. I will tell you that for us here at MortgageWorks, we price FHA loans extremely well. We are rarely beaten on a rate in terms of an FHA transaction. So if you're contemplating an FHA loan, you definitely want to keep us in mind. And if you're a realtor, ignore the the kind of old news about FHA is a more bureaucratic program. They take longer to process and so forth and so on. Not really true anymore. So if you're a realtor working with credit score borrowers in the 680 and below, embrace FHA. It's a great option. It's going to get more buyers into homes, so you get more commission. So that's that. I just wanted to point that out because I think that's sort of what's been overlooked with this whole credit score and loan level price adjustment controversy on conforming loans, because the reality is conforming loans are not the best source for that kind of credit score borrower. So then moving on now to, the Fed's raised the Fed funds rate another 0.25% this week. That does affect certain loans directly, unlike a 30-year mortgage. What kind of loans does it affect directly? Well, credit card loans and HELOCs, home equity lines of credit. So you might say, well, gee, if they've raised the Fed funds rate another 0.25, that kind of hurts HELOCs, doesn't it? Well, yes, in the short run, I would say that's true, because that now means that the prime rate, which does directly correlate to the Fed funds rate, is now at 8.25. and most HELOCs are going to have a margin over that prime rate, and that can range anywhere from 1.5%, 2%. So that essentially means that HELOCs are basically bumping up against about a 10% rate level. But why would this Fed meeting this week and the Fed commentary after the meeting be potentially beneficial to HELOCs? Because of their commentary about a possible pause. If the Fed, in fact, does pause on their strategy of raising the Fed funds rate any further, that's good for HELOCs, because what that would suggest is you're not going to see any further increases in HELOC rates. And if we then see more and more evidence of a recession occurring, which, of course, on our last program, I had mentioned a presentation I saw where the economist suggested that we won't be in a recession for the next 2 years. That's an opinion, though. A lot of news still that a recession could occur. And if that does, that not only would cause the Fed to maybe pause on their increases, but maybe start to gradually lower the Fed funds rate. So if you already have a HELOC, that could be potentially good news. You may start to see that HELOC rate coming down again in the near future. And if you've been on the fence about getting a HELOC because you're worried about, why would I get an equity loan that's going to go up in rate over time? Timing wise, you may want to relook at that. If you still are looking for an access to your equity to get cash for any reason, this might be good timing for a HELOC. If we are at a pause and if we are plateauing in terms of Fed funds rate increases, getting a HELOC now could help you lower, ride those rates down if they start reversing course and lowering the Fed funds rate. And then the last thing I want to point out on equity lending, don't forget we do have a fixed rate, what we call HE loan option. These are traditional fixed rate loans, 5 to 30-year term. And right now, the rates on some of these, particularly at lower loan to values and higher credit scores, say 60 LTV and above 580 or 780, you're looking at rates on fixed rate seconds that are as good and frankly lower than a HELOC. So for those of you who would like to avoid the whole HELOC variable rate feature entirely, don't forget that a HE loan, a home equity line, a home equity loan, fixed rate loan is still a good option to consider. So keep that in mind. Now, moving on, I want to go ahead now and close with sort of a little teaser question for next week. And this is something I run into from time to time, and it's an interesting scenario. So let me go ahead and present you with this question. A borrower with a 655 credit score has been pre-qualified for an FHA loan and would like to purchase a lower price condo. Let's assume they're a first-time home buyer and they're looking for a property at the lower end of the price spectrum. Well, if that's the case, here's the question. Will the borrower be able to do so, buy a lower price condo using an FHA loan with a 655 credit score? Will they be able to use an FHA loan if the condo development is not on the FHA approved condo list? Because as you may know, or I may have mentioned in the past, for FHA loans on condos, the condo development has to be on the FHA approved condo list, which is maintained all the time. The reality is a lot of condo developments are not on the FHA approved list. So for a borrower who needs to use FHA to qualify for a home purchase and they want to buy a condo, can they do so if the development's not FHA approved? Well, as to the answer, I'll leave you hanging. Tune in next week where we will have the answer, and it's going to be on the house. Thank you. And Jeff, back to you.
Art, you are one tricky devil here. I was just leaning on the edge of my seat going, God, okay, is he tricking us? What is this a trick question? I've got a loan, I'm approved, but the condo may not be. So I'll have to tune in next week and find out.
Right.
Hey, I just had one question here pop up, and it was about the banks. And I'm not expecting you to be an economist or anything of that nature, but you see a lot of people or this move to take money out of local banks, which offer the lower rates, and putting it someplace else or protecting their investment or their deposits. What do you see that? Do you see that having any impact on the Fed's decision to lower rates or to raise rates? What's the situation there in your opinion?
Yeah, I think that's another factor that is associated with the Fed's conclusion of their meetings this week, where they did indicate that their approach going forward is to likely pause. The issue there, I think the concern is that after the initial Silicon Valley Bank scare, that seemed to settle down in a relatively quick period of time.
Mm-hmm.
And then it kind of reemerged here in the last week or so with the latest banks, First Republic, and now, of course, Pacific Western Bank has hit the news. And so what's happened is the markets have gotten jittery again, which is why you've seen the stock market sell off over the last couple of days. So I think it's a kind of a balancing act, because with this banking phenomenon kind of reemerging, I think that combined with there are some signals that the economy is slowing down and maybe getting recessionary, that would be an environment where it wouldn't make a lot of sense for the Fed to keep hammering hard on raising the Fed funds rate more and more. So I think the banking, or I'll call it the perceived banking crisis, combined with some recessionary signals, I think is another reason why the Fed is suggesting that they're going to kind of go slow and maybe pause for a while. I think that's the right approach. Now, as to the banking crisis, I don't know. I mean, it seems interesting that when we had the first one, then eventually what happens is a big bank steps up and buys the assets of the failing bank, and then everything seems to be okay. That seems to be happening again with Chase stepping up and saying they're going to buy First Republic. So to the extent that occurs when some of these mid-range or lower or smaller banks fail, then I think that's going to kind of keep things under control and keep things from really falling apart like we saw in the Great Recession of 2008. So
it's not again, it's that checking in with reality and staying away from the henny penny, the sky is falling.
Right. Exactly.
Another question is, and you offer this with, and you've talked about it now for a few weeks, and that's the buy down, the 3-2-1 and the 2-1 buy down. And I keep reading about the pressure on housing, and we still have a tremendous shortage when it comes to housing. How do you see builders, the Toll Brothers and that whatnot? How do you see them leveraging, or do they leverage the buy down to help sell new homes?
Oh, absolutely. I mean, I've commented before that the new home industry, unlike the resale markets, has always been a lot more dialed in to using financing as a tool to spur sales in environments like the one we have now. Because the builders are affected as well by the fact that prices have been pretty lofty, and with the rates moving up how they have, it's affected prospective new home buyers in terms of just being able to qualify, as well as the fact now new home buyers are a little bit less inclined to, again, particularly if they already own a home, to sell that home, cash in all that equity because they want to go buy something brand new and give up that 2 3/4 rate and have to deal with something, at 5.5 or 6. Builders are tuned into that. They understand that concern. And so there's lots of evidence of many different subdivisions out there where you can see in their marketing efforts, they're offering financing incentives. And before rates went up, it was generally limited to closing cost credits, mostly for the purpose of directing the buyer back to their own in-house lender. Now what's happening is they've increased those incentives to feature both temporary and permanent rate buy downs to help address that affordability concern on payment and be able to offer a new home buyer a payment lower and maybe closer to what we saw a couple of years ago because of the subsidy in the rate, either a temporary or permanent subsidy. So yeah, builders are good at that. They're actively doing that. We are seeing some evidence of that strategy being used in the resale markets by sellers. I encourage sellers to think about that when they're listing their home. I'm encouraging buyers who come to me to be pre-qualified, don't jump to just lower your offer price because you think you have leverage because the market's low. If you like the home, consider staying closer to or offering full price, but then the concession that you want to get out of that, you should gear that toward a buy down, whether it's a permanent rate buy down or a temporary. It's going to be much more financially beneficial to the buyer, the borrower, to take that approach rather than just doing a lowball offer on the price and going with a market rate.
Great advice. Great advice. Hey, that's why you're the expert. And before we let you go, let's put a little information on the screen about how people can get more information and to contact you. He is at MortgageWorks. This is Art Alvarez at 760-883-5700. Or you can go to their website at mwloan.com. And you saw it earlier when we first started. it's a plethora of information on there. He's got all kinds of articles, as well as the rate chart on there on the 3-2-1 buy down we're just talking about, and the rates for FHA financing. You can also get a hold of Art at mwloan.com. And Art, you also have a cell phone. Why don't you share that cell phone with us?
Exactly. Of course, that's the one that seems like everyone calls me on these days, 714-612-9035. So feel free to use that number, 24/7, weekends, day, night. Give me a call, send me a text. I'm available whenever you need some answers.
Fantastic. Well, Art, I know that you have a slogan. I'd like to end with that. And thank you again, and we'll see you next week.
Thank you, Jeff. And remember, at MortgageWorks, we have the answers and they're on the house. Take care.
Take care, everyone.